It's going to be yet another wild week, that's for sure. There has been no shortage of that recently, I can tell you, when you look at the markets, the geopolitical tensions, what's happening in the economy, and so much more. But what we have today is a comprehensive and in-depth analysis as to what's happening, but I gotta make it real easy, so stay tuned. All right, the first thing I want to look at is the central bank actions that are taking place right now, that have already happened, and I will show you as it relates to inflation, because that makes a difference to you, the individual. The second thing is the major inflows. Billions of dollars are going to be flooding into the markets this week. So will it be a long-lasting rise or a dead cat bounce? We'll talk about all of that and more. Let's begin. We'll begin right here. US inflation is probably about to spike yet again. Central bankers in Russia, Mexico, Poland may raise rates. As I have said before many times, we are looking at central banks around the world increasing their interest rates in response to what's happening with inflation. Bank of England, Governor Bailey will speak after the latest tightening. That's important as well because the action itself, very important, increasing interest rates. But we want to hear from the central bankers and what they say because that's their forward guidance. Some people don't understand the fact that part of what they say in advance and as well as after the activity is really, really key and sometimes almost as important as the actual action itself. Here you can see the CPI and the core CPI both going up in the United States and just about all over the world, their own measurements having the same situation occurring. Both of these are moving up. It's putting pressure on the individual. There could be one reason or another, but we've got to understand there's been trillions upon trillions upon trillions of dollars that have been pumped into the system, whether that is from a QE or something like a QE from a central bank around the world, or from the fiscal side. The governments around the world have engaged in you could see the debt here. I want to say a monetary experiment like we have never seen before. It comes from the fiscal side as well. The governments doing anything they can to make this system continue. Of course, everything is finite. Here you could see, it might be small on your screen. As always, links will be in the description, but you're looking at the different countries, Japan in the middle. This is just showing us, as it says right here, government debt by country. This is the debt to GDP ratio, 2021 numbers. Japan, 256%. Around that, you could look at this. Again, not in absolute terms, but in relation to the GDP, you've got Greece, you've got Italy as well. Not far behind, Spain, you could see here, France, you could see here, and Canada. Don't forget Canada. Not only the people heavily indebted, but the country as well. Now, what's going on? We've got commodities off the charts. I've shown you that. Just a quick update. Brent crude oil futures touched $94 a barrel. And guess what? The dollars a barrel may not be an impact to you directly, but it's indirectly affecting you. When you go to the pumps, that's a problem. But everything relies on transport these days, whether we like it or not. And I assure you, this is going to have an effect on the prices you pay for just about everything. It's crazy the way it works. ECB's not sees interest rate hike as early as October. So you've got the Dutch central bank chief saying, this is the way it's looking. We don't know if that's going to be the case, of course, but certainly we're heading into that time. And what's going on? At this time, you've got shortages, you've got this demand, this insatiable demand to move stuff from place to place. You're looking at the truckers getting more than they ever have before, okay? This is just one particular company, just showing you how much they are willing to pay, 97.5, so essentially $97,000. The top 50% of drivers making that, according to this one company, but I've seen all kinds of different companies just throwing out the incentives because they cannot get what they need. They need more drivers. They need more volume to be pushed out. So of course, that's going to create supply and demand issues. So right now, definitely this is going on. And more than ever before, the employees starting to have the upper hand. There's no relief in sight for high trucking costs. That's according to Bank of America. I do agree with that, of course. And then we have this: Ford to suspend or cut output at 8 of its factories due to the chip shortage. What does that mean? People involved in this directly are going to be impacted in a negative way. But then again, you've got all of these other businesses, maybe the truckers that were bringing stuff around, they're not needed. So what happens to them? Well, all these different things. There's so many different connecting elements to this. And it's just so crazy because we just don't have the data around what happens. It's all anecdotal evidence. It's all estimations. It's all guesses. But the point here is simply that we cannot rely on this fragile system. And that's why I tell people to prepare for yourself, for your family. We've got to figure out different ways because it's just not as robust as it was made to be seen. You look at that over the past couple of years, very clear. Now let's talk about stocks. Let's talk about what's happening in the markets. Let's look at this starting from the high level, and we work our way down into the nitty gritty, but I'll move through it quickly because I know that's going to be a lot of detail here, but just understand. Plain and simple answer here is that billions of dollars are going to be thrown in this week, and there are 2 reasons why. Bridgewater sees market turmoil on aggressive Fed tightening. Investors may underestimate the risk of inflation and rate increases. I do agree with that. Chinese assets look attractive with Beijing easing policies. So basically the whole world, most of the world, is going towards tightening, including the ECB this year. My goodness. And then you've got China basically going in the complete opposite direction. Okay, really interesting. And now, could it be that the whole world slows down and then China picks up? They really need to get the engine moving, that's for sure. I've shown you what's going on in China, not just with Evergrande and the real estate fiasco, but of course the whole economy really slowing down. So they need that to pick up. Okay, this is just showing you specifically that when the Chinese markets opened, they started rocketing after being closed for quite a while. And now, because of their, their New Year's and everything is all over, the vacation's over. So now you have them coming back and things are roaring up higher. We don't know if that's going to continue, of course, but that's the way it is as of now. This right here, largest January, remember, global equity inflows by year 2022. You could see here shaping up to be, or I should say, has already been one of the biggest on record. Can you believe that? Despite, think about it, despite, January wasn't good at all. What are you talking about? Well, that was the US markets. There is another market, however, that performed extremely well during this period. Take a look. I did talk about this in a previous video, of course, as I always try to highlight as much information that, maybe it's useful to one group of people or another. That right there, what I'm showing you where the mouse is, I hope you can see that right about there. That's January 5th of this year. And you could see this has gone up. What are we talking about here? This is the Brazilian stock market. The Brazilian stock market specifically, this is the EWZ, the ETF of that. But I showed you essentially, hey, this has just been performing so poorly over the last little while, and this could turn around, and it seems like that has been the direction, no doubt about it. So cash has been flowing into other markets, not necessarily the tech stocks that we have seen before. But this right here is huge, and I think I have a couple of charts surrounding this. US share buyback authorizations. I mean, my goodness, the amount that has been authorized for share buyback. What does that mean? Companies buying their own stock. They are the number one, since 2009, they are the number one buyer of stocks. How crazy is that? But that's the world we live in today. And then we look at it on a different level. Investors brace for turbulence in U.S. corporate bond market. Surge in trading of credit default swaps points to nervousness that equity sell-off will spill into fixed income. So the bond market, huge, massive, and we are seeing some concerns there. What's happening? Well, of course, you've got rates rising, and that affects everything from mortgages to companies, because remember, these companies, look at Apple. Perfect example. Apple. You're looking at any given moment, biggest company in the world, one of the biggest companies in the world, and they borrow money. They actually borrow money. Why? They're sitting on, the last time I checked, it was something ridiculous, like $200 billion of cash or something. They're still borrowing money. But as rates rise, they're less inclined to do so. They also borrow, by the way, these companies borrow to buy back their own shares. It's a whole different story though. This right here probably looks like mumbo jumbo to a lot of people, but it's just showing you the gamma exposure. And all you got to take from this is that we have head into negative territory right now. Okay, write down. And if you see this historically, what does it result in? A bounce back. What does this mean? Translation, money GPS translation here, that there could be a bounce. We could see the markets rise. Which market rises? Well, we don't know exactly. This is just showing you the SPX, but you know, where the money rotates into, I think it could be a different story. This is just showing us what has performed well over the last, few months. And the Dow has clearly outperformed, okay, when you look at the four broad indexes. So we could see more money moving into those type of stocks, but we'll see. This is just the same chart here. Months with the largest global equity fund flows. January is big. February is also big. Okay, so let's keep an eye on that because as you could see, February 21, that was big. But we got to understand what has happened over the last little while. And I do believe that there's this desire to move money as a result of what's going to happen in March with the Federal Reserve. Percentage of total flows into equity mutual funds and ETFs. So it just shows us here that February, all I'm trying to say, February is generally a good month. Okay, I don't want to beat a dead horse. I'm moving on quick. I promise. I promise. Stick with me. Don't go anywhere. Don't click off. 12-week rolling sum of equity fund flows. Breaking it down. Where's the money going to? GPS, tell me. All right. I got it. Value funds and cyclical sectors are seeing more cash flowing in versus growth funds like tech and so on. Less money going in. Look at this. Since September. I've been highlighting it specifically when you look at it in November, the markets themselves. But there are only a few stocks that have been carrying the whole thing. We talk about that a million times. And then you've got the global fund flows. Equities, everything's rising, of course, because why not? But despite what we're seeing today, you look at that, there's still money going in. Cash, it's sort of hasn't been the same since 2019. And then bonds. And I wonder if now bonds will see more of an inflow because they become more attractive at this point. If rates rise, I'll keep an eye on that. And then, of course, the zombies, I love it. Rising share of companies with debt servicing costs that are higher than the profits. That's the zombies. If you saw the thumbnail I did on the video 2 videos ago, you see those zombies. That's what this is talking about. Okay. And then we have global negative yielding debt. I just showed you in the 2 videos ago that negative yielding debt. And in literally the span of 1 day, this has changed dramatically, even less. Right now, there's under $5 trillion worth. Why? Because the rates are rising so fast. It's incredible, isn't it? And you stayed until the end. I wanted to show you this. This link, as always, included in the description. BLS job revisions show every job report in 2021 was total garbage. The BLS made huge revisions in the number of monthly job dating all the way back to 2017. If you want this entire report, Mishtalk has it. I will include that. Maybe I could do an entire video about that if you guys are interested, but I think it's important to see what happens with the jobs because that's so key. We see a huge departure, a big change in what has been going on over the past 2 years. It's crazy to say the least. Look, this was a chart GPS episode. Hope you appreciated that. I haven't done one of these massive ones in a long time. So I'm going to try to do my best to bring you the details from all different angles so we can be prepared and aware and have that knowledge. If you do appreciate it, simply hit that thumbs up button. Thank you for that. If you haven't seen this video yet, you definitely want to check it out. Click it and I'll see you there.